We are speaking one day approximately after fiscal second quarter 2026 earnings call. It was quite a good call, quite impressive. So let's dig into it and see if we can understand it even better. So it was an amazing quarter for a couple of reasons. First, I think that it was a comfortable sort of beat, but the beat was from already highly elevated expectation. We had, I presenting here revenue and the earnings estimates. We had a range of estimates from, I collected those from Yahoo and TipRanks. Each one had about 30, probably a lot of overlap between them. So we had a range of about 105 to 115 in terms of revenues in billion. And then we had EPS in range about 1.6 to about 2.15. And in the middle here, you see the consensus and the consensus of the three estimates, myself, TipRanks, and Yahoo. And then we have the actual with a big red arrow on it. And not only did it beat the consensus, but also you can see what happened a year earlier, which is the circle at the bottom of the graph. Well, in the case of the revenue, and a little bit more towards the middle in case of earnings per share. So the beat was from already a pretty high growth rate expected from the year before. So we haven't seen this in a while. So now you can see here the way these performed. We have this measure of how each of us, myself included, performed relative to the actual results. And in the case of the first three bars here, they are from revenue point of view, and then the last three bars are from EPS. Black represents my error. I was about 1.8% under the estimate that it was delivered and 1.6% on EPS. So revenue and an EPS. And then you can see red is Yahoo and blue is TipRanks. So, speaking for myself, I was perhaps a little bit too conservative on my revenues, and I was a little bit more accurate, relatively speaking, on EPS. So this is just a check on the performance here and how the estimates went. Roughly speaking, again, I think these are not big errors, 1% to 2%, the worst case 3% on the consensus basis. Now, on the segments, these are the actual growth that we ended up with, of almost 22%. I think that you could round it to 22% on the iPhone, 16% on services, 8% on the iPad, which is impressive, 5.7% on the Mac, and we'll talk about that a little bit, and 5% on wearables and growth. Now, again, from performance point of view, here's how my estimates are the blue ones, how far off I was, overestimating on the right, above zero, underestimating on the right, overestimating on the left. And you see these. I'll publish all this stuff, by the way. Don't worry about having to read it closely. But it gives you an idea of how we all ended up on these estimates. These include Apple 3.0 Independent and Pro as published by Philip Elmer DeWitt. And so I replicated these here so you can see the performance of another set of analysts. Again, the worst case, you're looking at an 8% overestimation on the Mac. I think a lot of people, once they saw the Neo come out, once they heard about the Mac Mini stockouts, when they heard about the clawbots, everybody buying up all these Macs, and there was an expectation of a big boom in the Mac, but those all happened fairly late in the quarter. And my expectation was a little bit also over, but not as much. When I was off about 3% on that estimate. So although you saw 5.7% growth, it wasn't like some people expected, the double digits. Also, the pros had the same fault there. Overall, though, I think these are pretty impressive. I didn't break out the regional or China. China grew extremely well. None sort of other Asia, rest of the world that grew very well. Management also pointed out that they're doing very well in developing markets. So overall, regionally, there were some extraordinary performances. But as we see here, just the iPhone was incredible, 22%, very similar to performance in the previous holiday quarter, where, again, unprecedented growth, or at least in the near history of the product. And we'll get into some reasoning why that is. Actually, we'll get into it now. People talk about super cycles. People talk about the assumption that we have these giant surges once in a while. Well, that is sort of, here's how to look at it. There's two graphs here. The bottom graph shows in green the net sales, but trailing 12 months. So it's smoothed out so we don't see the spikes on the holidays. That's the green line. Above that, we have the EPS line. Now you'll see how they tracked very similarly for a while, and then they began to diverge. That occurred around COVID. It also occurred during the surge in services, especially subscriptions and services. But still, there's a similar pulse, if you will, a cyclicality to it. And there are some surges in there. Part of that has to do with the introduction of a new form factor. This has been true all the way back since 2012. When a new iPhone comes, there's especially a new distinctive looking iPhone. People will go out, especially in China, buy it for showing off that they have the latest, which is nothing wrong with that. But then there's a period where that surge, first of all, the second year usually is not the same, or is not new, it's the same form factor. That has to do a lot with tooling. That's a long old story that the iPhones tend to be depreciated. The tooling is depreciated on a 2-year schedule. So you're going to produce roughly the same look a couple of years in a row. And then by the next cycle, you'll see people upgrading or replacing their older phones. So you're going to have this, I guess, what they used to call a supercycle. And you see it also in the upper graph where I try to separate out of sales just the phones. And now this is an estimate because we haven't known unit sales for the phones since 2018. So some of that is an estimate. But you'll see again, once you smooth out the cyclicality, you'll see these surges once in a while. Now, again, this is a valid observation, but I don't think it's the main driver. The oscillation isn't huge. And in the phone, it might be significant, but it's a blend of many things. This graph is particularly interesting, the bottom graph, as it demonstrates also how the gray areas is when the stock price fell. And the red line represents the derivative of S. And you'll see how when that is about to dip, there's usually a stock price sale going on. And so there's maybe, I wouldn't say it's predictive, but it's an interesting pattern to go through. So what's happening now, you'll see from the iPhone, I'm just going to highlight it here. There's a new surge happening. Now, when Tim has asked this question, he's been asked this question already for the last two calls. He says, the iPhone 17 is really nice. People really love it. And that's a good answer. But the fact is, it's a distinctive looking product. Some say it's the orange color, but it's certainly attractive. And I don't see it being that different, but then I'm not very conscious of the outward appearance being important. So we're seeing this pattern, a nice surge. We'll get into the guidance in a minute, and that actually demonstrates that we are in some kind of an acceleration. But here's the thing, underneath all that, services is just absolutely steady growth, compound growth. And as a result, it just lifts the whole story. Here, services is at the bottom. Normally in a graph like this, you want to put the oldest product to the bottom and the newer one to the top. But I wanted to highlight the fact that services is foundational in the sense of showing how it holds up everything else. Most people put it the other way. They say the iPhone holds everything up. But services is looking more and more to be the thing that keeps people in the ecosystem. There's a lot of value there. There's a lot of things people depend on there. And I think that one of the reasons people don't switch. So it's another one of these stories that people aren't appreciating enough. It's been years and years of pounding the table on services, but here you can see it, just how important it is, the tide that lifts all the boats, and the boats being all the products. So let's now talk a little bit about margins. Now, unbelievable margins. We just hit almost 50% on gross margin. Here is the blue line. And that's composed of two subcategories. We have services in red at the top, and we have products with the purple triangles and, again, the smooth line beneath that or through it. And although product margins are exceptional, they're right around 40%, those services, again, are pulling the whole average up. You can see that bend in the curve in the blue line, where we were very steady around 40%. But as services took more and more, I wouldn't say share, but involved more and more, it just pulled the whole curve up. And we also see here operating and net margins, which also are going up naturally. There is a little bit more operating expense. We'll get into that, which maybe decreases the slope of the bottom line. But it's still, this gross margin is absolutely incredible. We just haven't seen anything like this since 2010, 11. We saw that surge back then, and then it sort of leveled out. And everybody was happy with 40%. And now we're flirting with 50. I just cannot believe it. Just one more thing. I remember being an analyst decades ago when I was looking at different companies in hardware and software, in phones and computers and so on. And everybody was really impressed by Microsoft because Microsoft, from a gross margin point of view, they don't have any hardware at the time. They didn't sell hardware, but they just sold software at the time. Maybe some of it was in boxes, but there wasn't any physical product. And they had an 80% gross margin because, again, there was very little cost of sales. And everybody was just like, wow, that's exceptional. 80% margin business is a money printing machine. And everybody was impressed and jealous of Microsoft that it could pull that off. Of course, Microsoft, a software company, is going to have extraordinary margins, right? Again, this is not net margin. This is gross margins. And so for a phone maker like Nokia, that was something to be jealous of. And here we are with Apple service as a significant component on the business, approaching also almost 80% right now. And it's still rising. I just can't get over how impressive this is. Just as we talked about a little bit about the difference between gross and net, you have to take out the operational expenses. And this is what we have here. And we don't see a lot of these graphs. And it's interesting what's happened. Obviously, you see R&D overtaking on an absolute basis, which is to say the absolute spend on that's reported. So R&D overtook that already in 2021, overtook SG&A. And now it's just somehow almost vertical. I think by reading a little bit the guidance, I think it's going to taper a bit into the next quarter. But what we see is a significant R&D increase, also as a percent of sales, which you're seeing below in the graph below, but in a stacked fashion. In that sense, the two of them together are now approaching, haven't yet reached a percentage of sales that was in evidence around 2007 and 8 when the iPhone was just emerging. But you'll see back then, R&D was tiny, SG&A was huge as a percent of sales. So much so that R&D, this is during Steve Jobs' era, R&D was like sales. And now it's approaching 8, which is extraordinary because that's just an engineering company. That's an engineering company that's doing breakthrough work. And that's something that Apple's not recognized for doing. So there's a negative side of, okay, you're spending a lot on R&D. The positive, though, is that Apple is actually really doing a lot of fundamental research now. This isn't fixing products. This isn't updating OS. This is engineering that is really driving, might be considered. And that's something I've said this to the media when interviewed about this and the succession. I said the new CEO will need to be, this is before he was announced, I said would need to be someone who is acceptable to engineering because Apple is an engineering company today. Fundamentally, culturally, it's an engineering company and is being now led by an engineer. Steve Jobs was not an engineer, and the other CEOs were engineers. Tim Cook was an operations man. He was excellent in a fundamental part of the business, and that is acceptable to engineers, culturally speaking. But the is that John is an engineer's engineer. He understands the culture of engineering and will understand how to motivate and retain talent, as well as to allocate capital effectively, not wasting it, dreams, and tendency to try to chase these dreams, by the way. So you got to be harsh sometimes to shut things down. So it's an eye on the R&D. It's a great story. It can be a problem if there are downsides to an engineering-led company where, again, you turns into kind of an engineering welfare state. So engineers tend to get projects and do a lot of navel gazing, which needs to be managed carefully. Now we're going to enter a section that deals with capital. Oh, but before I do that, let's touch on active. Active is the number of users, the fundamental measure of the value of the company. It's not counting iPhones, it's users. And these are comments from management, just so we capture those. Sometimes they're mentioned, sometimes they're not. So here's what we have exactly on the topic. Record on customers new to the Mac. They mentioned that Mac lifespans have been long, which is good and bad. About the iPad, half the being new to the product, over half. Same Apple Watch. This has been going on for a while. So when we see, this is going to be important when we measure install base, because if we see every quarter an estimate for the number of watches or Macs or iPads, you just take half of that and allocate it to the install base, and the other half install the growth of the install base. So there's an interesting way to measure that, and I've been applying it. We're going to keep an eye on this. And as I mentioned with respect to India during a question, that the iPhone, Mac, iPad, Watch, all of these majority of customers are new to the product in India, as you would expect, part of the developing market story. But the drum is still getting beaten, and that's a positive. Always want to look forward to that every quarter. So let's jump in now to what I thought was the most unexpected comment during I didn't hear exact verbatim the comments from and point out a few things here, and I highlighted these things bold. I didn't highlight, but this 3.8 last quarter was 3.9, so that's not a surprise. However, open market purchases were only 11 billion. Now that is represented in the graph by the buyback, and that is this mustard color. And you'll notice it is extremely low. In fact, that's part of the stack. The previous quarter, we were over 25 on buybacks, so we're less than half that. This is an anomaly. You'll see that it does not match the rest of the graph at all. The blue area is dividends. The reddish area is for settlements. And the pattern to both. Dividends has been growing in a predictable fashion, sort of very steady. Buybacks have been somewhat a little bit, I wouldn't say volatile, but they've been steady, but up and down a little bit. During the last few periods, we've seen something unprecedented. Now, you'll see that the 11th from last quarter was offset by a much higher number the previous quarter, but on balance, we're still down. And there's comments that say that they are abandoning the net cash neutral position. And I'm wondering if it's already started, because this 11 billion caught me by surprise. I did not anticipate this, and really addressing it, and nobody asked this question. We'll try it out, but maybe through questions. But my impression is this is there's something. I will also say that I've highlighted there that our repurchase activity at any time can be affected by a number of factors that we take into account. So this was essentially explaining why sometimes there's a difference in the purchases, right? And then in the middle of that phrase or that commentary, he says, as you're aware, we recently announced a CEO transition. Why does that comment fit in the middle of a paragraph talking about the general theme? The only way I have to read this, for me, and I'd love to be wrong on this, it suggests that already CEO choice is one of the factors deciding how much to allocate to capital returns. It appears, and I might be wrong, but it appears that John is probably against the idea of huge returns to shareholders. So keep an eye on this. I found very, very strange, and out of Tim Cook. I'm not judging it. I'm just pointing out that it isn't normal. So here's the bottom line. This is the graph representing what's happening with the entire cash position and return of capital. The debt had decreased slightly, and it has been decreasing. That's a good thing. As interest rates go up, you don't want to hold debt. A lot of it is already fixed. They're not taking on more. I think it seems like they're paying it. Net cash, which is blue dotted line, has now been increasing in 2 quarters in a row. Now it's increased in the past, but never for long. It's had only 1 or 2 ticks, usually during the holiday period. Here we're seeing 2 ticks, holiday and the quarter after. Now, if you'll know, I'm going to try to zoom in. Those red lines represent what I would say were the trajectories to get to net cash zero. So that blue line, they announced it, which is roughly when I started drawing these lines. They announced that they're going to get there. They kept missing the target. You would see that another year, and they haven't. Overall, the trend is down, but they haven't kept that path down. And now they completely abandoned it. Again, we'll have why, but they're just observations now. The buyback, as I mentioned, halved, at least more than halved to 11. Net cash zero abandoned, net cash reduction. You'll see that the line, this blue dot, has gone down by about half. It was down even further than that until it came back a bit. So that is going from about 160 billion net cash to the current 62 billion which is the why we get 100 reduction, and 1 trillion overall return, which is again something they mentioned. In fact, they're at 1.085 trillion, and still 100 billion will be allocated further. Whether they actually spend it is another matter, but that's been approved. So now, is this good news or bad news? I don't think it matters. I think at the end of the day, the value of the company doesn't change because of this. The value might be captured in the share price, or it might be captured in your, as a shareholder's, percentage of that company that has been increasing. In fact, to the next slide. What does this mean? Are we never going to reach what I call the halving? Well, we were at the maximum 26.5 billion shares, and now we've reduced that to about 14.6, would be 13.2 and 27. So we're still going down, but 1.4 billion shares to go before half what the max was. Now, this is an arbitrary figure. I just thought it was an interesting target to have. And as you can see, it's getting asymptotic. As the price goes up, it should be harder and harder to get there. We have 100 billion allocated, 260 billion at the current share price would need to be spent to get to half, but probably we're not going to get there. I really don't. If I were a betting man, I would say we're probably going to taper. Big changes. Let's look a little bit at this. This is on what management already communicated. So do this. Put the numbers. You will get revenues coming at about. They guided 14 to 17. So I'm estimating conservatively right now. That gets you, if you put in the other numbers, the margin, the tax, and do something of the share, we're still going to probably see a share reduction. We're going to look at EPS 192, which is another 22%. This is what we had last quarter as well. Gross margin, putting it at the top of the guidance, they guided high and they went over. So I'm going to assume they're going to still guide towards the upper end of the range. I'm actually exactly at the upper end of that range. If that's true, if those things are true, the iPhone almost necessarily to grow about 19%. Now here I'm dialing the Mac way up 18% because I do think they're going to get a lot more Mac Neos into customers' hands. Now that's a lower price point, but it will drive sales. So yeah, I could be a little bit on this. If I am, the iPhone needs to go a little bit higher because I still think they're going to get the revenue there. They did warn that iPad is facing a tough comp, so I'm putting iPad down 3%. Wearables at home, 4%. It was 5% last time. So maybe consistency there. And services, just the same as before, 16%. Could come in a little bit less, but if it does, again, it's going to be put into something else like the iPhone. So overall revenue growth, I think 16% is very much being telegraphed. And as I always say, they already have April on their books. They're communicating exactly at the end of April. They're not going to lie to us and say, "Oh, I'm going to make up a figure based on what I don't know," or sorry, what I didn't know a month ago. And I think they know about a third already. So that's why guidance is so useful. And as you saw, nowadays people's estimates are very close. There's a lot of consistency. We're not off, where we're going to be. We're not off more than a couple of percentage. Whether it wasn't, that's just because they're so accurate on their guidance. And speaking of analysts, one graph. This is some of the latest price targets. I'm just trying to bring everything together that came out today. This is all very brand new. A lot of targets moved up. Not that that's all that important, but people are getting more and more excited. Almost all the time from anybody who has a positive, whether that is, outperform or effectively a buy rating, is now above $310. Target, there's two who are negative that are at 270 and Barclays and then there's a few which have no ratings. They're typically neutral. But overall, all these they used to be. Now, again, I don't use that very much, but it's worth keeping an eye on things just to get a sense of how the sentiment is out there. And it looks like the stock is responding positively today. Not by much, 3% or so. Last I checked, but that's the story today. So, given that, this is my first take on the quarter. Love to take questions.